Welcome to the deep dive. Today we're plunging into a company that really highlights this huge gamble between, groundbreaking ideas and their actual market value.
Right.
Richtech Robotics, that's RRR on the NASDAQ.
Yeah, it's fascinating. Some people see it as like the absolute future of service automation.
While others, they
I
look
see.
at it and see a highly speculative bet.
Exactly. And the numbers, well, they reveal this huge gap between the current market price and what the fundamentals suggest it's actually worth.
It's a tension that raises some really big questions, and we're going to unpack why.
And just to set the stage for you, all the data, market prices, and our analysis are current as of September 16, 2025. That's based on Richtech's closing price of $3.89 on September 15.
Okay, great. So we've got a lot to unpack for you today. We'll start by really understanding their business, how management is steering the ship, and what the financials are telling us. That's part one.
And then in part two, we'll shift gears. We'll look at market sentiment, who actually owns the company, the significant risks involved.
And finally, bring it all together with a comprehensive conclusion.
Yep.
Okay, let's kick off part one then. Chapter one, business analysis.
All right.
Let's start by really understanding what Richtech Robotics actually does and, how they're trying to make their mark.
So at its core, Richtech designs, manufactures, and sells collaborative robotic solutions. Think mostly the service industry.
Hospitality, healthcare.
Exactly. Hospitality, healthcare, even retail.
Mm-hmm.
Sectors that are really grappling with, labor shortages and rising costs.
And what's particularly interesting, I gather, is how they're doing business.
Okay.
There's been a pretty significant strategic pivot, right?
Absolutely, and this is really key. They're deliberately moving away from just selling robots outright.
Okay.
They're pushing towards a Robotics-as-a-Service, or RaaS, model. And this isn't just like a small pricing tweak.
Yeah.
No, it's a gamble to fundamentally reshape their relationship with customers.
Okay.
You can see in their numbers. For the 9 months ending June 30, 2024, product revenue actually decreased 55% year over year.
Wow. Okay.
Yeah. But at the same time, service revenue shot up a staggering 485%.
485%.
Yeah, and leasing revenue up 314%. This isn't demand drying up. It's a direct result of that conscious strategic shift.
So why make such a drastic change? What's the big advantage of RaaS, especially, for their customers?
Well, the biggest advantage for the customer is it removes that huge upfront capital investment.
Right. Buying a robot isn't cheap.
Exactly. Imagine a small restaurant or maybe a hotel. Buying a robot could be tens of thousands of dollars. RaaS makes it accessible, more like subscribing to software or leasing a car.
Makes sense. And for Richtech?
For Richtech, it means potentially long-term, predictable, recurring revenue. And it creates these incredibly sticky customer relationships. They move from just a one-off sale to a continuous partnership.
That sounds like a smart move for stability, but if customers aren't paying those big sums up front, doesn't that put a heavier financial burden on Richtech themselves?
It absolutely does, and that's the crux of it. This RaaS model is highly capital-intensive for Richtech.
Oh.
They need to build and deploy these robot fleets themselves, which requires a continuous stream of funding. This constant need for external financing is a central theme we'll definitely keep coming back to. Yeah. It's a high-stakes trade-off.
Got it. And when we talk about what they're actually putting out there, their product portfolio seems pretty extensive, covers a lot of ground in the service industry.
It really does. They've strategically segmented their offerings. In production and food beverage automation, you've got their flagship Atom.
The Barista Bot?
Yeah, the dual-armed barista or bartender. Plus Scorpion, their AI bartender. They even run their own coffee and tea restaurant as a real-world showroom for Atom.
Huh, interesting.
Then there's delivery and indoor transport. That includes Matrady robots for restaurants running food, busing tables.
Okay.
And Rishi and Robbie, which can actually call and use elevators in hotels. Plus the heavy-duty Titan for bigger transport tasks.
And cleaning too, right?
Finally, in cleaning and sanitation, they have the dissect line. Those are autonomous commercial cleaning robots.
So what's the thread connecting all these different robots, especially thinking about that RaaS model?
It's their AI cloud platform, or ACP.
Mm.
This isn't just some fancy name. It's the crucial software that underpins everything.
Okay.
It manages entire robot fleets. It optimizes workflows. It really forms the technological backbone of that RaaS service model. Without it, their whole vision for integrated automation just wouldn't be possible.
So for a company that's still relatively small, how are they positioning themselves? Are they gaining traction in the market?
Richtech is definitely a small cap player. The market itself is still nascent, early days, but it's expanding rapidly.
Right.
They're really aiming to be a first mover in this non-industrial service robotics market, specifically here in the U.S.
And are they getting robots out there?
They've managed deployments in 37 states, and they have over 30 regional and national distribution partners. But what's genuinely significant and what really signals their potential is the validation they're starting to get from big players.
Like actual contracts.
Exactly. They've signed master services agreements, MSAs, with large enterprise customers. There was a pivotal one in August 2025 with one of the world's largest retailers.
Wow.
And even a pilot program with a top 5 U.S. automotive dealership group. These aren't just small deals. They're strong signals of market acceptance and show a potential path to scalable growth.
So if I'm a business owner, maybe running a hotel or restaurant chain, why would I even consider Richtech? What's the core problem they're solving for me?
Their primary value proposition is very clear. They're tackling acute labor shortages and escalating labor costs head-on.
Big problems right now.
Huge. They allow businesses to reallocate their human staff to higher-value, more interactive roles, while the robots handle the repetitive, often less desirable tasks. And their key differentiator is that one-stop shop approach.
Meaning?
Instead of buying a delivery robot from one company, a cleaning robot from another, and, say, a barista bot from a third, Richtech aims to be the single vendor for multiple automation needs. That integration could make a big difference for businesses.
Okay, let's zoom out a bit. Let's talk about the broader industry they're operating in. You said it's exploding.
Indeed. The service robotics industry is really at a turning point. It seems poised for explosive growth.
How explosive?
Well, the global market, valued around $22.4 billion in 2024, is projected to surge to over $90 billion by 2032.
90 billion.
Yeah. We're talking a compound annual growth rate of 19.2%. This isn't just hype. It's driven by powerful trends.
Like what?
We're seeing pervasive AI integration moving beyond just pre-programmed actions to physical AI, where robots learn and adapt. That's crucial for Richtech's ACP. There's also the rapid adoption of collaborative robots, or cobots, in food and bev, hospitality, healthcare. And maybe the most undeniable driver is those persistent structural labor shortages. Automation is becoming less of a luxury, more of an operational necessity.
So they're playing in this massive growing sandbox, but who else is in there? You mentioned competition earlier.
Oh, it's fiercely competitive.
Yeah.
Richtech faces some formidable threats.
Like who?
On one side, you have these industrial giants like ABB. Their annual revenues are around $33 billion.
Okay, that dwarfs Richtech's $4 million TTM revenue.
Completely dwarfs it. Then you have highly focused, venture-backed private companies that are incredibly well-funded. Think Bear Robotics, they've raised over $175 million. Or Purdue Robotics, which has already shipped over 100,000 units worldwide.
Wow.
And others like Keenan Robotics, Relay Robotics, they're significant players too.
So Richtech is really the David against multiple Goliaths here.
It's exactly that scenario. Their first mover advantage is quite fragile. They need truly superior execution and differentiation to stand out when there's such a vast resource disparity.
And what about regulation? As these robots become more common in public spaces, hotels, restaurants, is that becoming a factor?
It's still a pretty nascent area, legally speaking. Currently, it's more of a patchwork of existing standards. But yes, as robots integrate more into our daily lives, there's a definite risk of new, potentially more stringent regulations being introduced down the line.
Makes sense.
However, it's not all open season for competitors either. There are significant barriers to entry that actually protect incumbents, companies like Richtech, that are already established.
What says?
Well, for starters, the sheer capital investment needed for R&D, manufacturing, and especially funding those RaaS fleets is enormous.
Right, that capital intensity again.
Exactly. There's also a real talent scarcity for specialized AI and robotics engineers. And then there's the technical integration complexity, getting a robot to seamlessly call an elevator or talk to a restaurant's point-of-sale system. These are not trivial challenges.
So when you lay all that out, it sounds like Richtech's competitive edge, their moat, is still very much aspirational. It's something they're building, not something they solidly have yet.
That's a really critical point. Their brand is still minimal, right? Small public company.
Okay.
But they're actively building it positive media, associations with NVIDIA, Columbia University. For cost advantages, they just lack significant economies of scale right now. Their own SEC filings highlight risks around raw material costs. So any edge here has to come from better software or maybe innovative design, not just producing cheaper units.
And network effects, switching costs.
The primary path there lies in that AI cloud platform, ACP.
Hmm.
If they can get customers deeply integrated with that platform, managing multiple types of robots, that could create significant switching costs down the line. It's a long-term vision.
And unique assets, patents.
It's 7 pending patents, 2 trademarks, and they definitely tout that one-stop shop broad product portfolio as a unique capability.
Right.
Whether it is truly unique and sustainable against specialists remains to be seen.
We've covered a lot on their business model and the market landscape. Just a quick reminder, if you're finding this deep dive valuable and want more like it, please do like and subscribe to Stock Analytics AI on YouTube.
Yeah, support the channel.
Members get priority deep dives on all S&P 500 stocks over the next few months, plus exclusive priority access. And if you want a one-off deep dive on a specific ticker, just drop us a super thanks.
Great way to get your stock covered.
Okay, now let's shift our focus to the people actually steering this ship. Chapter 2, Management Evaluation.
All right, leadership.
So, moving on to the leadership team and their strategy. Who's in charge?
Well, the management team at Richtech Robotics seems very strategically put together for a company in this specific space.
How so?
You have Zhen Wu, or Wayne Kwong. He's the co-founder and CEO. He brings over 2 decades of tech experience, actually co-founded a telecom provider before this.
Yeah.
But crucially, he also has a background in the hospitality industry.
So he understands the customer's problems firsthand.
Exactly. That gives him direct insight. Then you have Matthew Casella, who's appointed president in August 2023. He has this really unique blend of experience.
Oh, yeah.
Deep finance background, Brown Brothers Harriman, UBS, combined with hands-on hospitality operations experience. He actually worked on tech deployment at LYFE Kitchen.
Interesting mix. Finance and operations.
Right. So this pairing, the technical founder, the industry expert who gets the problem, and the finance-savvy leader, it really seems to check all 3 boxes you'd want for a growth-stage robotics company. It looks like a notable strength on paper.
That sounds like a strong profile. Did they demonstrate agility during, say, the recent turbulence, like the pandemic?
They actually did.
Yeah.
The company showed pretty impressive adaptability during COVID-19. They pivoted their delivery robots towards temperature screening pretty quickly.
Oh, right.
Then, once the immediate crisis passed, they shifted focus right back to the labor market challenges. It suggests a management team that can adapt to dynamic, unpredictable conditions.
And what about communication, ethics? Anything stand out?
Based on our research materials, communication seems transparent, mainly through their SEC filings and investor presentations. Ethically, the executives consistently frame their mission as enhancing human interaction by automating the menial tasks, emphasizing that human touch. We didn't find any red flags or ethical concerns raised in the source materials.
Okay. Now let's talk about where they're actually putting their money. For a growth company like this, capital allocation is absolutely key.
And their capital allocation strategy is unequivocally focused on aggressive organic growth. There's no history or any current plans for M&A, mergers, or acquisitions.
It's all build, not buy.
Exactly. Research and development, R&D, is a clear, significant priority. They spent $1.63 million just for the 9 months ending June 30, 2024.
And accelerating.
Yep, accelerated to $533,000 in the most recent quarter alone. That's a 38% year-over-year increase. It signals a strong, continuous push for innovation.
And the other side, sales, admin costs.
Sales, general and administrative SG&A expenses also jumped dramatically, up 256% in the most recent quarter.
Wow, 256%. What's driving that?
Mostly new hires, headcount increases, the costs of being a public company, and physical expansion, like new offices or facilities.
So this spending profile, is it normal for this kind of company?
Oh yeah, it's exactly what you'd expect. It's typical of a high-growth, pre-profitability company deliberately sacrificing short-term earnings to grab market share and establish a technological lead. Spend now to hopefully win big later.
And for a company in this growth stage, I imagine dividends and share buybacks aren't even on the radar, right?
Not at all. Any talk of dividends or buybacks is completely off the table. All available capital is being reinvested to fuel this massive growth opportunity they see.
Makes sense. What about return on invested capital, ROIC?
Well, because they're not yet profitable, their ROIC is currently negative. It's around negative 14.18%.
Okay.
But for a company at this stage, the critical question isn't the current negative ROIC. It's what the future ROIC could become if the RaaS model scales successfully and they actually achieve profitability. It's really a deferred promise.
Got it. Okay, we've built a picture of their business, their strategy, their management. Now let's get down to the brass tacks, the numbers. Chapter 3, Financial Analysis. This is where things get truly eye-opening.
They really do. Richtech's financial profile is, as you said, full of stark contrasts. On one hand, you have a strong balance sheet, healthy gross margins.
It's good.
Very good. But this sits alongside significant net losses and, critically, that sky-high valuation. Let's quickly run through some key metrics. These are as of September 15, 2025.
Okay, market cap.
Around $592.26 million.
Okay, almost $600 million. And revenue, trailing 12 months.
Just $4.13 million.
Oof. Okay, big gap already, gross margin.
That's the positive story, around 76%. A significant strength. It shows the core business can be profitable on a per-unit or per-service basis.
But the net margin?
Deeply negative, minus 366.21%.
Minus 366.21%.
Yep. A direct consequence of that aggressive growth spending we just talked about, the R&D, the SG&A.
Okay, what about stability, debt,
Yeah.
liquidity?
Their debt-to-equity ratio is exceptionally low at 0.01. They have almost no debt. And their current ratio is extremely robust at a 120.23.
120, that seems incredibly high. What does that mean practically?
It signifies extremely strong short-term liquidity. Essentially, they have a substantial cash cushion, likely from recent stock offerings, to cover immediate obligations many, many times over.
Right, so they have cash, but they're burning through it.
Precisely. Looking at revenue growth trends, they only went public in November 2023, so there's no meaningful 5-year history. Their recent quarterly revenue, $1.18 million, actually missed analyst consensus expectations of $1.42 million.
Why the miss?
It reflects both the naturally lumpy nature of hardware sales — big deals don't always land predictably quarter to quarter — and the fact that RaaS recurring revenue takes time to build up. It doesn't switch on overnight.
Gotcha. And profit margins, just to reiterate.
Healthy gross margins, yes, but those deeply negative operating and net margins are driven by the heavy investment needed for growth. And when it comes to free cash flow generation,
Let me guess. Negative.
unequivocally negative. Operating cash flow was negative $3.13 million in the most recent quarter alone. They are burning cash, not generating it. This cash burn is absolutely central to the bear case and highlights their ongoing reliance on capital markets.
So despite that significant cash burn, how stable are they financially? I mean, that super high current ratio and low debt must count for something.
From a stability perspective, yeah. Their earnings consistency is, well, consistently negative due to that growth investment. But their debt-to-equity ratio of 0.01 is exceptionally low. Their growth is primarily equity-funded, which significantly reduces financial risk from a debt perspective.
Okay.
And that current ratio of 120.23, as we discussed, demonstrates extremely robust short-term liquidity. They have a big cash cushion for now. And, naturally, dividend stability and growth just aren't applicable here.
Okay. Now we arrive at the part that really jumps out, the part that's potentially contentious. Valuation analysis.
Indeed. This is where the story gets wild. Traditional metrics like price to earnings, simply not applicable. They don't have earnings.
Right. So what do we look at?
The most relevant relative metric is the price to sales, PS ratio, and it stands at an exceptionally high 143x.
143 times sales.
Yes, 143 times trailing 12-month sales.
Yeah.
This number just screams that the market is pricing in absolutely monumental future growth. It's highly speculative, driven almost entirely by the narrative, the story.
Okay, that's the market's view. What about intrinsic value, if we try to calculate what it should be worth based on fundamentals?
Right. If we look at an educational intrinsic valuation using a discounted cash flow, or DCF, model, which tries to project all future cash flows and discount them back to today, that model estimates an intrinsic value of $2.22 per share.
Wow, 22 cents compared to the market price of $3.89.
A vast chasm, isn't it?
Explain that gap again. Why is the DCF so much lower? Is it just because they're not profitable yet?
It's largely that, yes. A DCF model is fundamentally grounded in cash flows. For Richtech, with minimal current revenue, negative cash flows right now, and the need for huge ongoing investment just to potentially generate positive cash flow way out in the future, the model reflects that present reality and the significant risk.
So the DCF is the show me the money now view?
In a way, yes. It heavily discounts those far-off, uncertain future profits. The market price of $3.89 reflects a highly optimistic story, a belief that they will capture a huge market and become massively profitable. The DCF reflects the sober reality of minimal revenue, negative cash flows today, and significant execution risk.
So the bottom line on valuation?
An investment in Richtech at its current price is therefore a very clear bet. It's a bet that the optimistic market narrative will triumph over the reality of its current financial statements.
Okay, that sets up part two nicely. Let's move into how others are weighing this exact equation. Time for chapter 4, market sentiment.
Let's see what the wisdom of the crowd thinks, or perhaps the madness.
So, what's the general feeling out there? What are the analysts saying?
Well, the professional analyst community presents a somewhat contradictory picture, actually.
How so?
The consensus rating from the 3 analysts covering the stock is a buy. That suggests they believe in the long-term story, the business model. However,
There's always a however.
there is. The average 12-month price target is $3. The range is $2.50 to $3.89.
Wait, so they rated a buy, but their price targets are below the current price of $3.89.
Exactly. That $3 average target implies a potential downside of over 20% from where it's trading right now.
So they like the company, but think the stock's gotten ahead of itself.
That's precisely the interpretation. They seem to like the underlying business and its potential, but believe the stock has run too far too fast. We've even seen one firm, Freedom Broker, recently downgrade the stock to sell, specifically citing valuation concerns.
Interesting disconnect. But recent news seems to be boosting the stock anyway, despite those targets.
Absolutely. The general media tone has been largely positive. It seems fueled by a steady stream of partnership announcements. Remember that master services agreement with a major global retailer in August 2025.
Yeah, you mentioned that.
That news sent the stock climbing 23% in a single day. News about their expansion into China was also met positively.
So the narrative is winning, at least for now.
It clearly demonstrates the stock price is highly sensitive to news flow. It's driven more by narrative and future potential than by current financial results.
Okay, beyond the headlines and analyst ratings, what are the more technical market indicators telling us?
Well, short interest is exceptionally high.
Meaning lots of people are betting against it.
A significant number, yes. There are 16.92 million shares held short. That represents 16.4% of the public float the shares available for trading.
16%, that's really high.
It is. It signals significant bearish sentiment from a notable segment of the market. A substantial number of investors are actively betting the price will go down.
What are the implications of that high short interest?
Well, obviously it shows strong skepticism, but it also introduces the possibility of a short squeeze.
Where rising prices force shorters to buy back shares, pushing the price up even faster.
Exactly. So it can contribute to high volatility in both directions. Now, looking at its price relative to moving averages,
Where is it trading compared to its recent trends?
it's currently trading significantly above its 50-day simple moving average, which is around $2.31. And it's well above its 200-day simple moving average of $2.14, more than 50% above, actually.
So the recent trend and the longer-term trend are both strongly positive.
Technically, yes. These are generally seen as strong technical indicators of positive short to medium-term momentum and a sustained long-term uptrend. It suggests buyers have been in control.
So really mixed signals then. Analysts cautious on price, huge short interest betting against it, but strong positive price momentum recently.
A very mixed bag indeed.
Yeah.
Tells you there's a real battle between bulls and bears here.
Okay, let's shift gears again. Chapter 5, ownership structure. Who actually owns Richtech Robotics?
Richtech's ownership structure is quite distinctive. It's characterized by exceptionally high insider ownership combined with relatively low but growing institutional participation.
Let's break that down. Institutional ownership, the big funds.
Top institutional ownership stands at about 11.1%. You've got major players like BlackRock holding 2.84%, the Vanguard Group with 1.09%.
Is 11% high or low for a small cap tech stock?
It's relatively low, but it has been growing. A significant driver for this increase was the company's inclusion in broad market indexes, like the Russell 2000 and 3000, back in July 2025.
So index funds had to buy it.
Exactly. That lends a certain amount of credibility and stability as passive funds become owners.
And what about insiders, management, founders?
Insider holdings are a real standout feature here. Ownership is estimated between 27% and 41%, depending on how you count. That's very high.
Who's the biggest holder?
CEO Zhenwu Huang himself owns somewhere between 19% and 20% of the company. That usually signals strong alignment with shareholder interests. His wealth is tied directly to the company's success.
But I sense another however coming.
You sense correctly. However, looking at recent insider trading activity over the past year, it has been exclusively sells. There have been no open market buys recorded from insiders.
Only selling. Any significant sales?
Yeah, for instance, the COO, Phil Zhang, sold 100,000 shares on August 26, 2025 at a price of $3.01 per share.
selling at $3.01 when the stock is now $3.89. Now, we always have to say, insiders sell for many reasons: diversification, taxes, buying a house. It doesn't automatically mean they think the stock is going down.
Absolutely true. Personal reasons are always a factor.
But that consistent pattern of only selling and at prices below the current market value, it can certainly be interpreted by some investors as a cautionary signal, maybe suggesting insiders felt the stock was fully valued, or at least not deeply undervalued, at those lower prices.
It's definitely a data point that bears watching and that market participants will interpret in different ways. And regarding ownership concentration overall,
Is it tightly held?
very. The top 25 shareholders control somewhere between 37% and 40% of the company.
What does that mean for regular investors?
It means founding management has substantial control over the company's strategic direction. It also acts as a pretty strong defense against hostile takeovers. But the flip side is that public shareholders have a more limited voice in corporate governance.
Right. Management holds the reins quite tightly. Okay, let's move on to the potential roadblocks. Time for Chapter 6, Risk Assessment.
All right, let's look at the potential pitfalls.
Maybe start with a quick SWOT summary: strengths, weaknesses, opportunities, threats.
Sure. Briefly summarizing the SWOT findings from the sources: strengths, that perceived first-mover advantage, the broad product portfolio, high insider ownership alignment, strong balance sheet, low debt, high cash, and that crucial enterprise validation they're starting to get.
Okay. Weaknesses.
Weaknesses: unprofitability and the high cash burn rate, their limited operating history as a public company, a current lack of scale compared to competitors, and that extreme valuation we keep coming back to. Opportunities: a massive addressable market driven by those labor shortages, the potential for the RaaS model to really take off and provide recurring revenue, opportunities for new market penetration, like education or government, and ongoing technological advancement in AI and robotics.
And finally, threats.
Threats: intense competition from both the industrial giants and those well-funded startups, the high short interest indicating market skepticism, potential macroeconomic headwinds, and geopolitical or trade risks.
Okay, let's hone in on a couple of those critical threats. Starting with the broader economic picture: inflation, interest rates. How do those impact Richtech?
The current macro environment poses a kind of dual threat for them. Higher interest rates directly increase the cost of capital.
Makes borrowing more expensive.
Exactly. For a cash-burning company like Richtech that relies on external funding, higher rates make future financing more expensive and potentially more dilutive to existing shareholders.
And affects customers too, right?
Yes. Higher rates also tend to slow down customers' willingness to make significant capital investments in things like automation. They might delay purchases.
And inflation.
Persistent inflation directly impacts Richtech's cost structure. It increases prices for raw materials, components, and the skilled labor they need, which puts pressure on those healthy gross margins they currently have. These are fundamental challenges for any early-stage growth company trying to scale efficiently.
Makes sense. And what about geopolitical factors? You mentioned trade risks. Tariffs seem like a big one for global supply chains.
They are, and the potential implementation of broad U.S. tariffs in 2025 represents a direct and material threat to Richtech.
Why specifically them?
The global robotics supply chain relies heavily on components sourced from China and other Asian countries. New tariffs on these components would directly increase Richtech's cost of revenue, their cost of goods sold.
So they'd have to choose.
Exactly, a difficult choice. Either absorb those higher costs, which would damage their gross margins, or pass the price increases on to customers, which could dampen demand, especially when competing against potentially lower-cost rivals.
Have they acknowledged this risk?
Oh, yes. Crucially, Richtech's own SEC filings explicitly highlight their reliance on third-party manufacturers and the risk of securing components at acceptable costs. Current tariff policies just magnify that existing risk.
Okay, we've covered a tremendous amount of ground: the business, management, financials, market view, ownership, risks. Let's bring it all together now. Chapter 7, conclusion.
All right, let's synthesize. Richtech Robotics truly presents this compelling narrative, this exciting vision, alongside a financial profile that is just full of extreme contrasts. And this leads to very clear, distinct bull and bear cases.
Okay, lay out the bull case for us one more time. Why might someone invest?
The bulls see an early entrant in a massive high-growth industry, fundamentally driven by irreversible trends like labor shortages. They see a broad product portfolio addressing key customer pain points across multiple sectors. They like the promising RaaS model for future recurring revenue. They see management's interests strongly aligned with shareholders due to that high insider ownership. And, critically, They point to the validation from large enterprise customers as proof of concept. It's a powerful story of future potential.
Compelling. Now, flip the coin, the bear case. Why this skepticism?
The bears look at the present reality. Richtech is currently unprofitable with a high cash burn rate, making it dependent on potentially dilutive capital markets just to survive and grow. It faces fierce competition from both industrial giants with deep pockets and nimble, well-funded startups. Its valuation is extreme by almost any conventional measure, with that price-to-sales ratio over 100x. On top of that, analyst price targets are significantly below the current share price. There's that pattern of consistent insider selling, and the high short interest indicates strong, active market skepticism.
So to hammer home that core tension we started with, the numbers right now speak very, very loudly.
They really do. Our educational intrinsic value estimate, derived from that discounted cash flow model trying to ground value in projected future cash flows, came out at $0.22 per share.
22 cents?
22 cents, which stands in incredibly stark contrast to the current market price of $3.89. This valuation gap simply highlights that the market is pricing in a far, far more optimistic outcome than what the current financial trajectory and all the associated risk we've discussed would reasonably suggest.
So what does this all mean for you, the listener? An investment in RR today, trading near $3.89, seems like a clear and, frankly, unequivocal bet. It's a bet on the narrative of future potential winning out over the reality of current fundamentals.
It really is. It's a wager that the company can execute flawlessly on its strategy, successfully navigate a very treacherous competitive landscape, avoid major operational missteps, and ultimately grow into its incredibly rich valuation.
Oh.
And while the potential rewards for that bet could be substantial if everything goes right,
The risks are equally significant.
absolutely, the risks of operational failures, competitive pressures, or just a shift in market sentiment away from hypergrowth stories are equally significant.
So maybe the final thought for you to ponder is this. When you look at a company like Richtech Robotics, how much of your conviction is based on that compelling vision of the future, the robots, the automation, solving labor shortages, and how much is grounded in the financial realities of today, the losses, the cash burn, the valuation, and how do you personally weigh that immense potential against the very present risks and that extreme valuation? That's really the core question here.
A tough balancing act.
Indeed. That brings us to the end of this deep dive into Richtech Robotics. We really hope this exploration has given you a clearer, more nuanced understanding of the opportunities and the challenges facing this truly fascinating company.
Hopefully it helps you think through the different angles.
And if you enjoyed this detailed analysis, if you want to unlock more insights like this, please make sure to like and subscribe to Stock Analytics AI on YouTube.
It really helps the channel.
It does. Members, for just €4.99 a month, get priority deep dives. We're covering all the S&P 500 stocks over the next few months, and members get exclusive priority access. And hey, if you want a one-off deep dive on a specific ticker that's caught your eye, just drop us a super thanks.
We'll bump it up the list. And please remember our important disclaimer. This analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice.
That's right. Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Always do your own homework.
Thank you for joining us on the deep dive. Until next time, keep learning and stay well informed.